how do the interest rates or the Fed funds rate impact mortgages, which then impact the demand for new builds or purchasing of homes? It feels like every day I'm reading, whether it's on Fortune, CNBC, Bloomberg, Wall Street Journal, just go through all the financial media. Someone is writing an article saying mortgages are up or down based on interest rates being up or down. Is it that simple? It's just like if the rates go down, more people want to go and borrow. If they go up, they don't? Or are there other factors that people should be aware of and paying attention to?
The housing market is the most rate sensitive sector of the economy. And when the Federal Reserve moves into its fastest rate hiking cycle in the past 40 years, it's going to have an acute effect on housing. And so we saw home sales drop at a pace that actually exceeded the 2006 drop in 2022. It was a huge drop in home sales at the pace. And we've since started to see that slow down, started to see that bottom out. We can see that in the leading data like mortgage purchase applications. But yes, where mortgage rates go, it's going to have an impact on the housing market. Now, the thing about mortgage rates is they're a long-term rate. So when the Fed is moving up federal funds rate, it's not like the mortgage rates and the 10-year yield are going to move up in sync with it. But the expectation for where future rates will go, where there's future federal funds rates will go, helps the financial markets to price long-term rates like the 10-year and like mortgage rates. And so right now what we've seen is we've started to see some data signal that the economy could be heating up a little more and we could have a little more inflation. And what that means is the Federal Reserve would hold short-term rates, the federal funds rate, up longer. Not necessarily go higher, maybe they would, but they would at least hold longer. And that sends mortgage rates up as the market prices in the future rate trajectory.
So Neil Kashkari, one of the Fed officials, he said almost exactly this, right? He said, look, if there's any sign of life in the housing market, that makes our job harder. And I saw that you were writing about this. When you see something like that, how much of the Federal Reserve's decision-making is looking at the housing market versus labor, inflation, kind of other data points, right? Do you think that it is a major component, or is it just one of many data points that they take into consideration in their decisions around that monetary policy?
Yeah, it's a core sector, and it's a core sector because they have so much control over it. And we've seen this now, in a very short window. When the Federal Reserve went down to 0% interest rates, in March and April 2020, when the pandemic hit, and then went in a massive quantitative buying spree, we saw housing start to boom. Now, work from home was also playing out and these other factors, but housing was running when unemployment was at double digits. And now when the economy, we have like a 3% unemployment rate, and mortgage purchase applications are at some of the lowest levels we've seen over the past 20 years right now. And that's in a very hot job market. So, they have a lot of control over housing, and they pay very close attention to it. And if home prices were actually start to, get some upward momentum, I think that would really raise eyebrows at the Fed. That's not what they would want right now. They want this to cool down. They want housing inflation to cool down and to help to bring overall inflation down, and also be a transmission vehicle into the rest of the economy. So you slow housing down, and that can feed over into the rest of the economy.